Hey everyone, welcome to the Building a Financial Fortress podcast, episode one, and the first one I've ever done. Um, I've been writing about financial uh, education for many years. My history as an investor goes all the way back to the dot-com bust when I was early in my career and got wiped out in the um, chaos and mayhem of that time. Jumped on the bandwagon with some crazy investments like Internet Capital Group, which I bought on margin and then went to zero along with a lot of other stocks, including some good stocks like Amazon and others. And that was my introduction into investing by buying high and selling low. And of course, that wasn't where it ended because then 10 years later or so, there was the Great Financial Crisis, which again wiped out my entire retirement savings. Although at that point, I decided it was time to move away from being on uh, defense and instead go on offense. And so that was really what caused me to start the blog and really start, thinking about how to protect yourself, from these, crazy market swings, which seem to be happening more and more frequently and with greater and greater devastation. Of course, the most recent one being back in March 2020 with the COVID collapse and then subsequent bubble, which is now starting to fall apart as we've seen recently with the stock market and the Fed talking about tightening. So it's been on my mind for better part of 30 years since I've been working, and I'm not an investment advisor or I don't have any certifications or anything like that. And this certainly isn't investment advice, but really just trying to educate people about how to protect themselves from these crazy markets, which just seem to be getting worse by the cycle. So I thought for this first episode, I would just begin by talking a little bit about the financial fortress concept. And, remember that this was, I created this back in 2008-ish. And, some things have changed certainly in my thinking over these years. But fundamentally, how do you protect your hard-earned wealth, your savings, and your investments? How do you make sure, you continue to grow your money? What's the best strategy to implement those objectives? And so if you think about your personal finances as a fortress offers you protection, peace of mind, from the wild fluctuations of the markets, the economy, worries about retirement or funding your children's education, life's unexpected expenses, etc. And so there's really five components that I sort of identified initially in the financial fortress. The first is really the base of the fortress, which is really cash and investment debt. Um, you really need to have adequate levels of cash to protect against uncertainties, for new investment opportunities. Sometimes cash offers a superior return to other asset classes, although not right now. Um, Investment debt, which is really, debt that you've borrowed, which, Robert Kiyosaki would call good debt, if you're going to invest it in something that generates a return, gives you some leverage to buy assets that can either generate additional positive cash flow, such as a mortgage on an investment property, or a personal loan to start a business or to make a new investment. Um, Bad debt, uh, which again Robert Kiyosaki would call things like credit card debts, auto loans, etc. Uh, you really don't want that because you're just you're not getting anything out of it. If you have cash earning 0.5% or less in the bank, you really should pay off the bad debt first because obviously the interest rates on that are much higher than what you're earning. And there's plenty of sources for doing those types of loans. I've used Prosper, over the years and even recently. Uh, and there's obviously other places you can go now besides banks to get consolidation loans and at least reduce the interest rate that you're paying on the um, credit cards until you can get it paid off. But that's, I think, still a good, sound, financial planning principle is get out of credit card debt. And if you are going to leverage yourself, make sure that you're putting it into, an investment. The second level up from the bottom really is insurance. And, it's very important to have liability insurance, life insurance, and property insurance. It gives you protection against accidents, lawsuits, protects your real and personal property in the event of a loss. Life insurance protects your family in the event of death and also can be used as a retirement planning vehicle. And I've actually written about that a bit in my blog. Um, the next level is really businesses and investments, which are really, two components. I kind of think of these as sort of watchtowers, where you sort of isolate the liability from the rest of your portfolio. Um, Either you have an outside investment with other investors, they're typically in an LLC or an LP, um, or it's a business, and I believe that everyone should have something else besides what they do at their regular job. Maybe it's something that you're passionate about. Ideally, it's not something that requires a lot of your own personal time because that's what you're basically trading when you're work a regular job, and so it's nice to have passive income coming in from different sources. Um, but you should always think about what business are you in? What is your, are you a real estate investor? Are you a, collector of, trading cards, let's say, and maybe that can turn into a business. There are many other possibilities. The next level up is really stocks, bonds, things like, master limited partnerships, retirement accounts, different types of investments like that. Um, it's really paper assets. So those can be sources of cash flow. Um, some even have upside relative to market appreciation. Um, this is really where you would have like your 401k, your IRA accounts. Um, if you can, I recommend you maximize your contributions into those. If you can do a Roth, do a Roth because those are fantastic because you can take the money out tax free in retirement. Um, if you make too much money to have a Roth, there was the back door where you could do a traditional contribution, non-deductible, and then transfer it or convert it to the Roth. But the current tax law draft that's on the table right now is looking to close that loophole. So not sure if that's going to be available this year or not, but it seems like it's going away soon. Um, stocks, that pay dividends, bonds provide, cash flow and really kind of help replenish, the base of your financial fortress. And I used to put alternative investments in that category, like royalties, cryptocurrencies, and private equity, but I actually um, have slightly changed that thought as we get to the top of the financial fortress, which is really the hard assets. And that would include things like tangible assets like real estate, gold, silver, commodities, and now I would put Bitcoin in that category as well. And these are really things that provide you with long-term protection against inflation, currency debasement, which continues to be a problem with our modern monetary system. Um, and you know, Again, real estate and commodities are a great way to build wealth too over time. You can get cash flow as well as appreciation. So that's really the financial fortress and how it sort of lays out. And really the top of the fortress are the hard assets. I've always had a real focus on hard assets because I think that they're you know over the long haul great ways to build wealth and preserve wealth, especially in market environments such as we've seen here in the last 20, 20 years or so, um, maybe longer, maybe 30. So, and I'll talk probably a lot more in future episodes about Bitcoin and sort of what my investment rationale is around that, why I believe it's, you know, uh, superior in many ways to gold, but comparable, and I certainly am advocating for diversification. I don't believe that you should put all your eggs in one basket. Um, and One of the things I do publish every month is a blog post that kind of breaks down my portfolio allocation, which helps, I think, visualize, how I break down, my asset allocation between the different, asset classes. I tend to be, lighter on the stocks and than probably most people, and heavier into hard assets, just because it's been my bias since the Great Recession. Um, and so you'll see that once a month. Usually, I'll have a blog post about that. Other than that, I do talk about a lot about Bitcoin, cryptocurrencies, and the rationale for investing in those assets. I'm not really huge into all the different cryptos. I do think that Ethereum, as a technology kind of venture capital type of investment is interesting. Certainly, the price has gotten clobbered lately, so it looks like it might be a good opportunity, good entry point. Bitcoin, same way, it's down around 35,000, I think, right now, a coin as I'm recording this. And I do think that those top two cryptocurrencies continue to be have promise, although they are very different in terms of their function and use case. Um, I really look at Bitcoin as a savings technology and a long-term store of value. People always laugh about store of value. Well, that's not really a store of value if it goes down 50%. Well, you have to zoom out. You have to look at it over a long period of time, and you know, uh, the way the monetary system operates is not going to change, and hopefully it doesn't collapse, but it's certainly not going to change its behavior, and all of a sudden have money become scarce. Money printing will continue in the future, that will continue to drive inflation. Inflation will continue to drive up assets prices, all asset prices really, but um, certainly, Bitcoin, Ethereum, real estate, gold, silver, all of those will benefit over a longer time horizon. I mean, in the short run, there's going to be volatility. There's going to be prices are going to go up and down, and you just have to not panic and not sell. And those are the mistakes that I made early in my investing career. Where when everything got cratered during the dot com, I sold everything at the bottom. And then the smartest thing to do would have been just to hang in there and wait. And that's kind of what happened to me again in the Great Recession. Although I did take the money and kind of went on a real estate buying spree, and I wrote about that in a book that I published on real estate investing for beginners, buying condos, and held on to them for a few years, and then sold them when they appreciated enough, and made a nice amount of money doing that. It was a contrarian move for sure, but it was interesting how many people were doing the same thing and how competitive it was to buy foreclosures and short sales during that time. There was plenty of people, plenty of competition, and we were writing multiple offers, and maybe getting 1 out of 10 kind of a thing to even potentially get into escrow. So, but that was kind of when I kind of shifted from I guess being a victim of the system to trying to take advantage of it. And then in the March, you know, uh, 2020 downturn, I was positioned pretty conservatively with bonds in my portfolio, and mostly, and I just kind of stayed tight and waited, and probably didn't get as much upside, in the recovery. Now I've really kind of shifted my thinking on bonds. In fact, I posted a post last week about whether or not bonds might actually be risky assets now. It was based on a podcast that I listened to on what Bitcoin did with Peter McCormick, which is really interesting. Couple really interesting guests on that one, Lawrence Lepard and Greg Foss, and both very, very smart guys, very much in line with my way of thinking in terms of how a portfolio should be structured and diversified. And Bitcoin obviously a strong position, as well as gold, silver, but you know, I'd been thinking about that for a long time, and I kind of got out of bonds in my retirement portfolio altogether. I'm slowly averaging back in now, but I just really didn't see the risk reward there, given inflation, and really rates are already pretty low. They're down around 2% on a 30-year, which if inflation's running even at 3 or 4%, you're still losing money. So it's just not a good place, in my opinion, to put your money. At least not right now. And our rate's going to go back up to whatever they were when Paul Volcker was finishing up his increases. They were, I don't know, high double digits. Probably not, because I think that level of interest rates um, would collapse the system. There's too much debt. There's too much government debt. There's too much private debt. The only way to keep it going is to keep the credit relatively easy. I think, in my opinion, I think the Fed's going to try, and the market and the economy reaction is going to dictate them to backtrack. China's already backtracking on that. They're already easing because they've got problems in the property sector, and they need to keep their economy growing. So I think Europe hasn't really meaningfully backed off of their easy money policies. So I think the macro environment looks really good for um, hard assets for sure. really even stocks, after this, meltdown, market correction, sell off, whatever is finished, there's going to be some great opportunities to buy some beaten down stocks, and you know there'll be definitely opportunities, but you don't. I don't think you want to have cash, too much cash. You need to have enough cash, of course, to for your emergency fund, and you need to have enough, for to take advantage of opportunities and things of that nature. But I wouldn't have excessive amounts of cash. Government bonds, corporate bonds, all that is just garbage to me right now. At least until rates are high enough that you're getting a real rate of return vis-a-vis inflation, which it could be 10 years before that happens. So those are kind of my overall investing themes, and again, I post once a month usually about my allocation. So if you're interested in that, you can follow my blog at fi-q.blogspot.com, and um, it's called Building a Financial Fortress: Personal Finance Ideas to Increase Your Financial IQ. If you're interested in it, I've got lots of articles in there. I've been posting, for many years. I kind of took a break for a while, but they go all the way back to 2011. So it's hard to believe it's been that long. Um, anyway, so that's pretty much it for episode one. So um, if you enjoyed it, please give me a like. If there's something you would like me to talk more about in the future, let me know. I think my next um, podcast will probably be focused more on Bitcoin and sort of the rationale around investing in it, what it is, how it works. I think that's something that I'd like to share. And then, and again, if there's anything else that you'd like to hear about, or please let me know, leave me a comment, and hopefully you enjoyed this. Thanks.